VanEck recently launched an Australian first, bringing global capital securities to the market. But before you get to Investopedia to figure out what it's all about, let's get John Caulfield from VanEck to give us the 101. Welcome to the program. So it's my understanding that these are sort of can be looked upon similarly to sort of hybrids, Australian hybrids. Is that correct?
Yes, absolutely. Thanks very much for having me on this morning. I mean, this is a global income solution from ourselves, and obviously VanEck, we're pretty well known for giving investors access to asset classes that others potentially don't. And as you mentioned, what are global capital securities? It may not be a term that people are too familiar with, but in terms of the instruments themselves, obviously a lot of familiarity with the local market. These are securities that are issued by banks and insurers. They're regulatory capital, and on the capital structure, they sit in between senior debt and equity. So you're spot on. I mean, the hybrid market here and the subordinated debt market here are essentially what we're talking about. But these are issued offshore, again, by large banks, large insurers. A lot of them are these globally, too big to fail institutions, GSIBs as they call them. Examples would be ABN, Lloyds, Rabobank, and the like as well. So, what is the opportunity? Essentially, it's a much larger universe out there. So you're just fishing in a much bigger pond, a much more liquid pond for that matter as well. It's an institutional market. Retail investors can't actually buy these instruments directly. So it's an access story, and you do need to go through a manager or an ETF, such as the one we've listed. Yields also look a lot better than the local market. You're getting essentially for the same issuer, potentially. We have organizations like Westpac who actually issue global capital securities in US dollars offshore, as well as the local hybrid market in Aussie dollars. But the instruments offshore tend to come at a higher yield or a higher spread. But like I say, familiar names, familiar credit quality, really just different risk return opportunities out there. So you can get a higher yield and also the potential for some capital growth. So in terms of the solution, we've partnered with Bentham, and Bentham are a very experienced global credit manager. They've been managing capital securities for close to 20 years. They take a very active approach, obviously combining some top-down views with some very specific credit analysis on these companies. And it's a very high conviction portfolio as well. So it's the VanEck Bentham Global Capital Securities Active ETF. That started trading on ASX on the 5th of August, and it trades under the ticker GCAP. And importantly, it pays you monthly income. And the yield we're sort of quoting on this at the moment is a yield to worst, or a yield to call, essentially, is around 3.5%. And to put that into some context, you'd say the average Aussie bank hybrid yield is probably a nudge over 2% at the moment. And we also saw Macquarie issue some notes last week, which were massively oversubscribed, and the yield to worst on those, comes out at about 2.9%. So I think that just gives you some context as to what's available out there and who doesn't want a little bit of yield in the current environment.
Answered all my questions, John, and we're short of time, so thank you.